Last week was a lot on the theology and the heart and like, what does this look like biblically? This week, we're going to jump into some very practical things. And so I'm going to start with a 7-step framework. Before you go into this, I'm going to start investing and putting money aside. We have to actually go back to the broader personal finance journey. So there's a little journey. I talk about this in the Getting Money Right class. How many of you guys got to come to Getting Money Right in the spring? It was incredible. I'm so grateful you guys were in there. And we'll be doing Getting Money Right again in September. And it's a 7-week class where we literally sit down in the class and we help you build a budget. And we put together a debt snowball while you're in the class. And we put together the budget while you're in the class. And we set up round tables. And we have 2 table leaders at every table, and they walk with you throughout the journey. So the end of Getting Money Right, I began to introduce these 7 steps. We did a lot of this early steps in the class, but I said we got to look at the full financial journey. So step 1, tithe, create a budget, and put together your $1,000 emergency fund. It was funny because last week I walked over to the group over here, and the leader, the first thing that they said to their group is they said, if you don't begin by putting God first, they're like, what's the point of even investing? You've already missed the starting point. And they said, everything that God has blessed in my life, this is a leader of this group, said it started with putting him first and honoring him first. So I'm always going to put tithe first because biblically that is the first thing, to put God first. Then, as a stewardship pastor, I am going to want you to put together a budget as quick as possible because what we need to know is how much is coming in and how much is going out. And as we begin to look at the dollars, if we just put together a plan, we see a dramatic change in spending, in actual application, and it opens up our eyes to so many things we didn't even realize about our personal finances. So that happens in Getting Money Right. I won't spend a lot of time on all these points. I'm going to move fast at this section, but I wanted to set that very first step. Then I recommend beginning generosity. It doesn't have to be huge, but just living. One of our values at the house is that we're generous. It's a part of who we are. It's generosity is our joy. Then create a debt snowball. Begin to put together a plan to pay off debt. Then do a 3 to 6 month emergency fund. So start putting together savings to replace your income if you lost your job for 3 months, or if you had to move and all of a sudden it's like, oh, I'm without income for a season. We want to start to put together an emergency fund and then save for a down payment on a house. That's step 3. Step 4 is where we actually begin to look at what it means to invest. Step 4 is we begin to put together a list of our overall net worth. And I have a net worth calculator that we give in the Getting Money Right class. As I'm talking about it, I'm thinking, you know what? I'll probably email that to you guys this week. So make sure that you've registered for the class and that you're in there so I can send that to your email. But just write down, hey, how much do I have on the asset side? How much do I have on the liability side? And that can be property and investments and cash and vehicles, and then loans and debt and anything that's got a little bit of drag on your life. And then this is finally in step 4 where we talk about investing 15% of your income. And you might start at 1%. You might start at 3%. I was talking to somebody actually just the other day at dinner, and they said, hey, where I started was 3%. And then one day I got a call from my dad, and my dad said, hey, you got to go to 5%. Like, just move it up. You won't even notice the difference. They moved it up to 5% of every paycheck that came in. They set aside 5%. And then a few years later, they got to 10%. And then a few years later, they got to 15%. So I'm not saying that, hey, right now today, if you're not at 15%, you're in trouble. But I'm saying this is the goal. This is the vision that we want to work towards over time, is of everything that comes into your house, setting aside 15% for long-term savings. I like to think, and I won't spend too long on this, but I like to think about Joseph when he was in the house of Pharaoh and he's helping administrate, and the Lord gives a vision that there's going to be a famine on the land. And it says that he had the entire nation set aside 1/5, 20% of all their increase. So literally he had the whole nation saving 20% during the good years. And then during the bad years, because they had savings, literally the whole rest of the world, it says, and this would be the rest of the known world at the time, but the rest of the world was coming to Egypt saying, we want to buy grain from you because you were the ones that stored up for this unbelievable drought that hit the whole world. So the land of Canaan, where we see Israel today and what is the promised land of Israel, they all had to go down into northern Africa, into Egypt, to get their grain. And that is how the patriarch Jacob, whose name became Israel, not to go too far here, but he ended up moving down to Egypt, but it was because of good saving. So when I say 15%, I want us thinking, hey, what does it look like to save during these good years for any bad years that may come? All right, step 5, save for kids' college. Evaluate your life calling. We have a class that we did this summer called Purpose, Identity, and Calling. Anybody do Purpose, Identity, and Calling? Yeah. I know Solomon was in there. I see you guys. So it was a phenomenal class where you literally write your vision statement and your mission statement for your life. Step 6, pay off your home early. Start to think about an eternal perspective and generosity. And then step 7, disciple others on the process and begin thinking about your legacy planning and your estate planning. And I know that there are several people in this room that already have started to put together that plan of, okay, Lord, I've had 20, 30, 40, 50, 60, 70 years of an incredible life of walking with you. Lord, I know that I want to set up a plan for my kids, for my grandkids, not even just financially. But when we say estate plan, a lot of times we think, oh, I'm going to set together a financial estate plan. But what are the relationships that you want to pass on to your kids? What's the knowledge that you want to pass on to your kids? What are the core values that you want as a family to transfer into your kids? So the estate plan and legacy planning, wealth is a component of it, but what are the other quintessential things that actually make up who you are? Money, I love talking about money. I'm a stewardship pastor at heart. I do a class on investing. But money is simply a fuel to walk in and step and do more of what God has called you to do. So it's an accelerant. It helps magnify things that are already there. So if you have some hurts in your heart and you get a lot more money, those hurts are going to come to the forefront and be magnified. If you're healed and healthy and you're walking in wisdom, then that wisdom will be magnified. And so there's times where I'm worried if somebody's about to get more money because I'm like, you're not ready. And all the things that are inside of you that are not healed and ready, or in your relationship with your spouse, or, all these things, your kids are in a place where if you just pour money on those kids, it's going to create problems. You're like, oh, that's going to be a best life. It's like, it might be like a sugar high. It might feel good for a minute, but if they don't have the foundational core values. So when I talk about estate planning and thinking about our vision and our future and our legacy, I like talking about money. But this is not all about money. This is about walking with God and having a right relationship with God. And that's what it said. The blessing is for those who have a right relationship with God, who are righteous and walking with the Lord. Okay, I had to put all that down. All of it is in your book. There are scripture references. There's sentences. I've got it all there. It's funny because I've given you guys my notes for the class. I actually have been putting together it's almost 80-page book now. It wasn't done in time for the class, but it's a workbook that goes along with this class I'll have available next time around, and I'll print copies, and if somebody wants to buy one, then you can buy one, and it'll be optional. But I've been pulling some of the notes and just dropping them in so you have something to go along with. So some of these things I'll move fast through. This is very practical. This is where I'm going to slow down. And I have some friends. They're going to help me slow down if anything is confusing. You guys see, I'm not on the platform today. I'm down here because I want to talk to you. If there's something that doesn't make sense, if there's something that you're like, whoa, slow down, say that again, shoot your hand up. Like, this is more of a dialogue. It will be mostly a monologue. It's not more of a dialogue. It's more of a monologue. But it is open to dialogue. Does that make sense? I want to hear from you if you have a question or have a concern. So here's what I want to start with. I want you to imagine that you have this idea, this dream in your heart, this desire to start a gelato cart. It could be ice cream. It could be any number of things. But in this scenario, the picture I found online was of a gelato cart. So it's gelato today, all right? Anybody have gelato? Anybody like the Italian ice cream? All right, it's pretty good thing. So, all right, you decide, I'm going to go start a gelato business. And what I'm going to do is I'm going to buy a $5,000 cart. I'm going to get a $1,000 chiller to keep it cold. I'm going to go buy gelato. You got to go buy the original ingredients, the toppings, the signage, T-shirts to sell, extra merch. So you take this amount of money. How much have you invested to begin your own gelato cart? $10,000. You put that $10,000 up front of your own money, your own time, your own energy, and it ends up being successful. Every day you go to work in your business and you sell gelato, and as you're selling it, you have to buy more, and some days you have to take a day off, so you pay somebody else to sell it. So you may sell some, but then you got to pay some. But over the course of a year, you make $40,000 of just straight profit. And maybe you earned $100,000, but you had $60,000 in expenses. But think about this. You go home with $40,000 of profit. That's a pretty good year. But what you discover is that $40,000 a year is like just barely enough to live on. And so you are enjoying the business, but every year you earn 40, and then you got to eat yourself and pay your own rent, and so you're spending 40. And you think, okay, what I want to do now is I don't just want to have my own job. I also want that business to grow. I know how gelato works. I know the market. I want to see this grow. And so you say, you know what I'm going to do? I'm going to start dreaming about an actual gelato shop, not just a cart where I go place to place. I'm going to go after a $100,000 location. And maybe that $100,000 is more chillers and more ice cream and more desserts that you can share. And you got to pay rent, but it's $100,000. You don't have $100,000. You're sitting there thinking, I'm earning $40,000 and I'm spending it down every year. What do I do next? Well, you go to your friends and you say, friends, I would like to open up a gelato shop. I can show you that I've done well with a cart. I can show you I have a profit. And I've been earning money, so would you be willing to invest? And your 10 friends all say, yeah, we'll put in money. It's $100,000. You've got 10 friends. How much do they each need to put in? $10,000. All right. What you do is you say, great, I am going to issue each one of my friends a stock. You've invested $10,000. Now I'm going to give you a little piece of paper, and I'll just kind of hand these around. You can just pass them out. I'm going to take the top one. I'm going to give you a piece of paper that says that you are a 1/10 owner. And this piece of stock now represents a piece of ownership in the business. Now, I pulled up this piece of stock that I've got here. This is an old Pennsylvania power and light company. This is not a gelato stock, unfortunately. But you can see at the top right that this stock certificate was for 20 shares of stock. Now, in this case, where we had 10 friends and they all got one stock, how many shares of stock are there? There's 10. 10 friends, 10 shares of stock. All right. Now with this one, this person in one stock certificate literally brought 20 shares. And there's enough to pass around and look at. I don't have enough for everybody to have one, but you can take a look at these. And you can see, it says that it was Blair and Company that purchased it. They bought 20 of them. And this is a certificate of that stock. So your 10 friends, they give you 10 grand. You give them a piece of paper. That's all they have. But that piece of paper represents a 10% ownership of that company. Does that make sense? All right. Are we good? All right. So now there are 10 shares of stock. The cool thing is your gelato company does well the next year because it's a location. You can sell more. Now you sell $80,000 worth, and you sell more than 80, you have $80,000 of actual profit. This is what you're taking home. So your actual profit comes home. How many investors are there? 10. So you decide, I'm going to, instead of keeping any of the profit for myself as the original owner, I'm going to divide, just think of this word, divide out the 80,000 to the 10 different owners. It's called a dividend. Divide out to the end. And I'm giving you some framework and some language because we're going to see these words come up later in investing, but this is what a dividend is. It's when the profits get divided out to all the owners. That makes sense? All right. So in this case, $80,000, 10 stocks, everybody gets $8,000. There are some companies today that every year they pay a dividend. This is just a part of their business model. UPS, you can go to Google right now and say, what is the dividend that UPS pays? And it's a little bit more than 6%. So if you have $1,000, or let me go 100,000. If you have $100,000 of UPS stock, every year they give you $6,000. You still have the $100,000 in their stock, but they just send you a check for $6,000 because you are an owner. When you buy stock in the company, you have picked up some of this paper for yourself. You become a co-owner of that company. Are y'all tracking with what I'm saying? All right. This is cool. It's cool to know that there are companies that literally will just cut, based on how much you have in them, they'll just send you a check every year. Because you're a co-owner, they divide out the income. Now, what is also interesting is that every year they're going to send you 6% of what you have invested with them, but that stock value can still go up and it can still go down. So maybe you've invested $100,000, maybe the stock value goes up to $200,000, and they were paying you $6,000 a year, now they're paying you $12,000 a year. Or it could go down. I'm not trying to get too fast here, but let me just show you a little example. So in our scenario, you have a $100,000 gelato shop. You've now been operating it for a year. It's earning $80,000 a year. It's doing really well. Somebody comes over to you and says, you know what? I'd be willing to give you $200,000 to buy that shop from you. Does that make sense? If you do well with your shop, that somebody might be willing to spend more and buy on it? Okay. What they call this is market capitalization. It's the market cap. Cap is the shortened word for capitalization. Capitalization is pretty much another word for money. How much money is your company worth overall when you divide it out amongst all the shareholders? So your company was worth 100. Y'all remember when we bought it for 100? We did a good year of business. Now somebody's willing to buy it for 200. So now everybody that's got a stock in the company, it was worth 10,000, right? They bought it for 10,000, but now it's worth 20,000. If you were to sell that stock to somebody else, say, well, we just had an offer for $200,000, so you get to choose who you sell it to and what you sell it for. But if you know the company's worth $200,000, you're only going to sell it to somebody willing to give you $20,000. Is that tracking? Making sense? All right. What we've just covered are three sometimes fairly confusing words in the investing industry. What is a dividend? What is market cap? And then what are stocks? What is equity? When somebody says equity, equity is another word for owning something. I have equity in that company. If you have your own business, you'll say, I have sweat equity in my business. I have been putting in elbow grease and hard work and labor. I've been sweating and toiling to build this business. In fact, in this scenario, the company was $100,000. The next year is worth $200,000. What grew there was hard work. Marketing, signage, displays, getting out and selling, meeting people, having people get excited about that, ice cream. So when you begin to look at investing, we've now put together a single company that we're all like, hey, that ice cream, I want to invest in that gelato shop. That gelato shop went up and doubled in 1 year. That's a good business. I want to put all my money in that company. And maybe you've experienced this. Maybe you started a company and you kept all your money in that company. You never took time to pull it out and to invest it into other companies or other stocks or other opportunities. There is a very, very high risk to only being in one single stock. All right? Anything can happen to that gelato company. So in this case, anybody remember COVID-19? Where literally the government shut down businesses for an extended period of time. I never thought I'd see that happen. I mean, it actually shocked me. I remember if you were not an essential employee, you were technically not allowed to drive to work. I mean, I don't know that a lot of people got pulled over for that in Texas, but technically, legally, they could pull you over and say, you're not an essential employee, you have to go home. You're like, well, I got to go to work. You don't have to go to work. You got to go home or we'll put you in jail. That was crazy. I mean, this is my personal opinion, not to get too crazy over here, but I'm like, that is crazy that happened. A single company is at risk. Let's say new competition comes in across the street. I feel like I'm killing it with my gelato over here, but all of a sudden a really cool ice cream parlor comes in, or maybe a swirl, a frozen yogurt stand comes in. Maybe they don't take all the business. Maybe they just take half. Competition can hurt a single business. Let's say the owner goes to jail. Probably going to hurt the business. Let's say that taxes on sugar goes up. Literally, the government just starts taxing more. Like, okay, that's going to pull away from your profits. Let's say that there's a person in the management team, somebody in operations, that's stealing a little bit every day from the cash register. It might not kill the company, but it might dramatically hurt the value of the company. Are you guys seeing that owning one company only or one stock only is actually very dangerous? Especially, you might be an owner, but you might not control what happens in that business. And even if you control what happens in the business, you don't control COVID. Like, there are things outside. This is why I'm like, you should be setting aside 15% a year over time, and Joseph did 20%, because you don't know what might happen upon this land. Okay, how many of you are familiar with Enron? Ever heard this name? Okay, a lot of folks. All right, I love this. So in the late 90s, Enron was this company that everybody knew. Everybody talked about. It was on its way up, and every year, it was almost every single year doubling. And it may take 2 years or 2.5 years, but just every 1, 2, 2.5 years, it would double. And then it would double again, and then it would double again. You guys saw the magic penny example from last week. If something's doubling and doubling and doubling, if you have 1,000, now you got 2,000, now you got 4,000, now you got 8,000. Very quickly, you're going to be attracted to that thing that is doubling very quickly. The whole market was attracted to Enron. Everybody thought, man, this company is gold. Let's all invest in it. And if you worked at Enron, it was like, oh, you work at Enron? Oh my gosh, that's incredible. Like, I wish I worked there. I get stock options. And so what you would do, most people, unfortunately, is they would put all of their investment directly back into the company and buy stock in the company. And some didn't buy stock in anything else. They only bought in one company. Anybody think I'm building up to something bad that's going to happen? So it turned out that Enron was shifting their financials around, and they had an auditor in place that was supposed to catch it, didn't catch it. And this is, again, something that tons of major Wall Street bankers and everybody that was in the investment world was like, oh, you should invest in this. This is a great option. Like, everybody was recommending it until they weren't. And it became found out they were taking some of their debt and hiding it in shell companies, and then hiding it in another shell company, and then hiding it in another shell company. So, like, it's still on their books, but it's hidden so far over here you don't see it. And it turned out that they weren't worth nearly what everybody thought they were worth. And it went from, like, I'm not going to hit this exactly right, but about $96 per share to $1 a share in 1 year. So all those years of doubling, and then in 1 year it was all gone. All right, this happens. If you put all of your money and resources, even if it's your own personal company, you do not know what's going to happen in your company. Now, you can control it more than you can control most other companies, but you should be, I'm going to use a big word here, diversifying and beginning to spread that money around. So I'm going to read diversification to you. And somebody said, hey, this isn't going to be a complex class. And I broke it down real simple for you. Here you go. Diversification is a risk management strategy that creates a mix of various investments with a large portfolio. Diversified means it contains a distinct asset type, distinct investment vehicles in an attempt to limit exposure to any single asset or risk. The overall goal is that we can smooth out unsystematic risks and events in a portfolio so the positive performance of some investments will neutralize the negative performance of others. All right, so now that we know what diversification is, go be blessed and have a wonderful evening. Okay, I love this word. I like investing. So often, this is why I broke the first three terms down so simply, it can be so confusing when you're talking to somebody about investing and they just throw out these big words. Can I tell you what diversification is? It literally just means to spread your money around. All it means is to spread your money around. Y'all probably don't know this about me. I almost every single night eat an apple with peanut butter. Almost every single night. I'm a huge fan. And so this is my snack before bed. And maybe it's not healthy to do it right before bed, but this is my snack almost every night before I go to bed. And if you put all the peanut butter on one apple slice, you think I would enjoy that apple slice? I like apples. I like peanut butter. But if it's all peanut butter and a little bit of apple, it is not going to be good. But if I spread it out across my apple and I lay it out where I have a nice spread, everything tastes a lot better. Are y'all with me? Y'all like diversification already? How many of y'all heard this saying? Don't put all your eggs in one basket. All right, if a basketball or a bowling ball comes through here and hits one basket, that's painful. But you got a couple other baskets there filled with eggs that didn't get hit by this unexpected event. When you're investing, you have to spread your money around. Are y'all with me? All right, Ecclesiastes 11, verse 1 and 2 says to ship your grain across the sea. After many days, you may receive a return. This is King Solomon writing. I'm going to miss the date here, but give or take 4,000 years ago, like 3,500 years ago, he's writing, you should be sending out your money, sending out your grain. You should be doing investing, hoping for a return. And then he says that you should invest in 7 ventures, yes, maybe even in 8. Don't put it all in one venture. Don't put it all in one place. You do not know what disaster may come upon the land. So when I think about investing and diversification, I start to think about all the different kinds of companies that are out there. So you could invest in ice cream, which was our example early on with gelato. I threw Bluebell in there. So you can invest in coffee. You can invest in home improvement. You can invest in medical, airlines, oil and gas, technology, banking, clothing, groceries. All of these different industries, and here are different companies that represent those, you have the opportunity. Don't go all in on Amazon stock. Amazon right now, great company, last 10, 15 years, phenomenal company. Don't go all in on one company. You have to spread it out around multiple. Okay, so we're going to come to the term mutual fund in a moment. Imagine that you have 4 different people, and they all say, I want to invest $1,000. And so these 4 people get together, and I've put my friend Leo, my friend Beth, my friend Jared in here, and I said, what if we all take $1,000 and we put it into a bowl? What have we done? Together, we mutually funded an investment, or in this case, a bowl. We have a bowl full of money now, all right? Now, what if we take that money? It was $1,000 a person, but now we got $4,000. We can go buy more companies. What if we take all of that $4,000 and we go buy really, really big companies, like some of the biggest companies in the world? Well, first off, we've mutually funded it, so it's a mutual fund. Second, we invested in large, y'all remember this word? Capitalization, large cap companies. So NVIDIA, Amazon, Microsoft, Walmart, Facebook, Google, These are $10 billion plus companies. All right, so let's just go back. Y'all remember that we had our market cap change as our business grew. These companies have a market cap of $10 billion plus. So for a company to be a large cap inside of a mutual fund or a large cap company, they have to have a $10 billion value. Mid cap is $2 billion to $10 billion. Small cap is $300 million. And I said billion here. That's not 10. Hang on. We're just going to fix this on the spot because it'll drive me crazy if we don't fix it. It goes to 2 billion, not 10 billion. All right. And then international is going to be non-US stocks. So are y'all with me for a moment? If we go forward and I'm looking for large cap companies, I'm looking at NVIDIA, Facebook, Microsoft. Medium size, Robinhood. Anybody order from DoorDash? Anybody? I saw a Mr. Beast video. He highlighted DoorDash all day long. Somebody paid him very well to put DoorDash in that video. Motorola, small cap, Chipotle, Mattel, Atmos. Now again, Chipotle is pretty large. Still probably worth more than $300 million, but it's not worth more than $2 billion. So they're small, but they're not small compared to you and I's business or time and energy. I'm not a $300 million guy yet. Praise the Lord, send it, Father. But if you look international, you would find Alibaba, TSMC, Novo Nordisk from Denmark, TSMC's in Taiwan. Go ahead. Yes. So mostly when it's an international company, it will then break down from this is an international mutual fund that is an international large cap or an international small cap. But most of the time when you hear of an international mutual fund, most of the time it's large. It's all large. There are a few funds, though, that will go medium and small, and you'll see that. But typically think they're $10 billion plus companies. All right, so now I have a little quiz for you guys. This will not be hard. Memorize the slide. Go. That may be a little bit hard. Okay, so here we are. Alibaba, Novo Nordisk, TSMC. What kind of mutual fund would this be? International. All right. Alibaba's in China, Novo Nordisk in Denmark, TSMC's in Taiwan. I've been to Taiwan, beautiful country, ton of great people. Atmos Energy, Chipotle, Mattel. Small. Good. All right. What if we do really big companies? Microsoft, NVIDIA, Facebook. Really big. Large. All right. Now we're back to that section. These kind of medium-sized companies. Where are we at on this one? Mid-cap. All right, hey, before you walked in today, would you have known what a mid-cap mutual fund was? No way. All right, do you feel a little more confident, especially with a large cap? Because you're like, I know all those companies. I've heard of Facebook and Google and Amazon. Like, okay, I've been around the block. Okay, check this out. What did we call this group before? Large cap. Okay, all of these companies are also known as growth companies. Because what they do, instead of taking their money and sending dividends out, hey, we just earned $100 billion this year. And some of them do. They earn $100 billion. And they could literally send that money to their investors. But instead, they put it back into the company, and they either buy another company and try to grow bigger, or like, I didn't put Walmart on here, but Walmart opens up another store. They get $30 million, well, probably $50 million in profits. They spend $50 million to open up another Walmart. They don't send that $50 million back out. They grow the company. That makes sense? So these are companies that are known for growth. So we've already said it's large cap. Now we know that they're growth. So what would you call a mutual fund that invests in large companies that are growing? A large cap growth mutual fund. Y'all tracking? All right. Now, this is almost comical. I'm sorry. This isn't confusing, but I'm sorry that it's so much here. These are also, in this scenario, these are all technology companies. Do you notice this? NVIDIA sells computer chips. Facebook is online. Apple, Tesla, Amazon. All right. You might also find all of these companies in a technology mutual fund. There are mutual funds, and I didn't break this down, but I talked about $4,000 early. What happens with a mutual fund is thousands and thousands of people from hundreds of different companies. We have access, and we'll talk about this next week, to different types of 401ks and IRAs. Thousands of people all put their money into the mutual fund. So the mutual fund actually has billions of dollars, not 4,000, billions of dollars. And then the mutual fund goes and hires an investment manager. And just this is where you start to think of Wall Street. Think of New York and maybe a whole floor on a skyscraper, and 1/4 of that floor is all investment advisors, and their whole job is to study Facebook, Microsoft, NVIDIA. Are they going up? Are they going down? Is the market good? Is it bad? Their whole job is to take those billions of dollars that have been mutually funded and to go find the best investments. Are y'all tracking with me on that? Okay. So what you'll find is there are some mutual funds. You go to the 100th story of a skyscraper. It's a whole company. All they do is they look at technology companies. You'll find another one. All they do is look at large cap companies. You'll find another one. All they do is look at small cap. And then eventually they get so big that they own that 100-story building, and different floors are looking at different sizes. Are y'all tracking? This is not like a perfect analogy, but this is pretty close to what's happening, all right? So what's interesting, and we talked about diversification earlier, is you might buy a large cap mutual fund, but it also has some of the same companies as a growth mutual fund, which also has the same as some technology mutual funds. So you might think to yourself, oh, well, I'm in a technology mutual fund, which has 100 companies in it, and I'm in a growth mutual fund, and it's got 100 companies in it, and I'm in a large cap mutual fund, and it's got 100 companies in it. There's a chance that the first 5 to 10 companies, or maybe even 20 or 30, are the same. But have you diversified? Yes, initially, because you purchase one of these mutual funds and they go invest into 100 or more different companies. But one quick note here is that you have to be aware. You could buy 3 very similar mutual funds and think you've diversified a lot, but you've actually just bought the same thing a second time. Are y'all tracking with me? Okay. All right, so Walmart, Exxon, Home Depot, these are companies that, I mentioned Walmart earlier as growth. It was a growth company in the 90s, 2000s. Now it's classified as a company that might be on sale, in that like the value of it might be more than what the actual cost of the stock is. This is how they classify it. And so they call it a value company. Exxon right now is considered a value company. Home Depot is considered a value. So if you look at companies that the market believes might be undervalued, and you're looking for a large, these are all large companies, large cap value mutual fund. So if you look at a growth mutual fund, it's going to put money into companies that are growing. If you look at a value mutual fund, it's going to put money into companies that are potentially undervalued. That's what they're looking for. There's no guarantee that that's exactly what's going to happen, but that's their goal, is to capture value when they buy those stocks. So if you buy growth, you're going to get one basket of companies. If you buy value, you'll get another basket of companies. So you could diversify with growth and have 100 companies, but you could have 100 over here and you could have 100 over here. Are y'all tracking with me? You might have thought this was impressive before you came tonight. Now you'll be like, oh, well, that's just easy. I own like 500 companies. I, David Thompson, am an owner of, I have an individual piece of stock from 500 companies. Pretty cool. But it's through a mutual fund, because I have mutually funded, and that mutual fund owns 500 different companies. And so I have a small percentage of 500 companies. Are y'all tracking with me? And it's probably more than 500, but you get the point. Okay, let me see where we are time-wise, because I don't want to kill you guys time. Okay, 7:50. My goal was to be done by 7:45. Y'all want 1 or 2 more slides, or y'all want to kill it right here? All right, 1 or 2 more slides. Okay, so we've talked about stocks. We've talked about mutual funds, and next week I'm going to start to show you where to find mutual funds, what type of rate of return to look for, what type of fees to be aware of. But I want to start this journey all the way with you starting your own company to understand what a stock is, so that as we go through and we look at, well, what would it look like to diversify across 500 companies, we have a better idea. So stocks, mutual funds, and I just want to quickly hit bonds, and we'll spend more time on this next week. What is a bond? And forget the financial side. When you hear the word bond, what do you think of? It's something that ties two things together, right? A chain can bond you. You can be in chains and bonded to something. You can be in marriage and you're bonded to someone. The word bond literally just means to put two different parties together, or literally here it says to tie things together. In the financial world, the word bond is a debt. It is when one person or one organization is bonded to another by debt. I've borrowed money or I've lent you money. Like if I lend you money, like we're bonded together. I'm coming after you. Now you may be paying me back. We're good. But I'm going to hang out with you till all that money comes back. All right? So when you think of the word bond, I want you to think, oh, what is a bond again? A bond is when you tie things together. And so what happens in the investment world is a bond is a way of giving someone debt or purchasing debt. Now, in our scenario with the $100,000 shop, what we had was $100,000 that we needed to raise to buy the shop. Well, we did that through stocks. We had 10 friends. Each of them got an ownership. We could have gone and borrowed $100,000, and then you maintain all the ownership of your own gelato company. But every year, you got to pay back the person you borrowed money from. So in this case, let's say you did a 5% bond. That means every year you got to send $5,000 back to the person that lent you that $100,000. Are y'all tracking? So every year it's $5,000 of interest. If you look over to the bond market, we'll come to that in a second, but if you look at government bonds, and everybody familiar with way back in the day, war bonds, and hey, you need to buy bonds to support the troops. This is way back in the day. So remember now we're all familiar, but it was like buy government debt. So the government now owes you money. You send the government money, they owe you money, but every year they're going to send you a small percentage rate. And what they said is we'll use that money to go buy guns and ammunition and planes to help fund World War II. Like this was how they funded World War II, was through bonds. So bonds can be used by the government. Bonds can be used by companies. If I want to build a company, I might issue a bond and owe debt to somebody. It is typically an interest rate. Well, it's an interest rate exchange. It's not an ownership exchange. But because of that, it might not be as high of a rate of return as a stock. The stock might grow, the company might grow. The bond is going to stay about the same. And we'll talk about this later, how the value of the bond can change. But this is the current government treasury rates today, treasury bonds from our U.S. government. If you give the government your money for 2 years and you say, hey, you get to hold it for 2 years and then you send it back, they'll give you 3.86% just to hold your money for 2 years. This is right now. I Googled it right before class. These are current numbers. If you say, I'm going to give the government my money for 30 years, let's say you give them $100,000 right now today, for the next 30 years, they're going to give you almost 5% a year. So for 30 years, they're going to send you $5,000. And then at the end, they have to give you your $100,000 back too. So you're going to get your original investment back, but every year you got paid 4.94%. Are y'all tracking with me on this? Okay, this is interesting because the last time I did this class that I put together the rates was, I think it was right before COVID or is during COVID, 2020, 2021, I want to say 2020 timeframe. And the interest rates were way lower back then with the government. So 2 years, you could lend them your money for 2 years. They wouldn't even give you 1% back. They'd give you 0.16% back. If you gave it to them for 30 years, they're like, great, we'll give you 2% for the next 30 years. I just think that, I need to put the dates on here. I just thought that is staggeringly interesting. Now, I'm not going to go into this here. It's not part of this class. It doesn't fit. But this is one of the reasons, if you watch the news at all these days, that everybody is so worried about how big our government debt is. And I should have put a slide in here. Maybe, hang on. Look at this on the fly, incredible financial acumen. All right, U.S. debt clock. If you go to the U.S. debt clock, here's the number that you need to know. $37 trillion that our government owes. And if you look down just a little bit, how much we earn every year is $5 trillion. So imagine that you earned $50,000 a year, but you owed $370,000. That's the equivalent problem that we've got right now. This is a real problem. Now, if you're paying 1% in interest on $30 trillion, it's painful, but 1% it's like 300 billion a year. Maybe I'm gonna mess these up a tiny bit, but think 300 billion a year. If it's not 1%, if it's 5% a year, you go from paying 300 billion a year on interest as a government to paying 1.5 trillion a year. And how much do we earn every year? 5 trillion. So you go from paying a very small percentage of your budget towards debt to paying a massive percentage. So that's a little extra. That's a little bonus for you. We don't have time to break down macroeconomics and talk about how you would solve that. But this is a major problem right now in our country. And I say major, I mean, like, we're all going to wake up tomorrow and have our jobs and, like, continue moving forward in life. But every dollar the government has to spend on interest is a dollar that they can't give somebody for Social Security or for education or for fill in the blank. And so this is why bonds matter in the larger scheme of everything we do. All right. Next week, I'm going to break down just a tiny bit of the history of stocks and the history of bonds so we can begin to understand a little bit more. The final thing I want to leave you with on bonds is that bonds are typically known to be a little bit safer because in general, they only pay out a normal percentage rate. But if the company ever goes out of business, they have to pay back the people who give debt first. So the people that own stock get paid last. It's like, well, you own the company. If the company goes down, you're an owner, you go down. But if you've lent money to the company and they can sell the buildings of the company, they can sell the assets of the company, all of that has to go back to the people who lent the company money. So it's generally considered safer. Again, if you put all your money in one company bond, that's too high risk. But if you spread your money around across 100 companies or 500 companies, then it's a lower risk investment. That make sense? All right, next week we're going to break down the percentage rates on some of these. All right, it's 8 o'clock. Any quick questions before we move on? And next week I'm really going to bring it home with some practical, here's what you go do. So any more questions before tonight before we break into our groups? And so what's better, corporate bonds or U.S. bonds? What's interesting about this is the U.S. has never not paid its debt. There's a little bit more risk today than there was a year ago, but it's never not paid its debt. And technically, they can print money. So technically, they never should not pay their debt. Now, if they print money, it inflates, and so everybody's money is worth less. But what's better, corporate versus U.S. Treasuries? Corporate is going to have a higher interest rate, maybe think 5, 6, 7%. And there are some that are higher risk, so they're 8%. U.S. is going to have lower risk, it's going to have a lower interest rate. In general, I would look towards corporate bonds, but then you're going to have to balance out the risk and realize that you might even do a mix. But I'll go into some mixes next week. It's good. Good question. It depends on your scenario, but in general, I would look at corporate bonds. Yeah, so when you put your money into the mutual fund, it's going into a big pool of money. And that big pool of money is sitting there, and then their goal is to get rid of that money as fast as possible into the companies. So they take all the, let's say it's $1 billion, and they want to invest 980 million of it. They might have a little bit of cash sitting in there, but they want to get as many stocks as possible. So they go buy the individual stocks as soon as you put the money in. And that's their job as the mutual fund, is to, as soon as you put money in, to take that money and buy more of that stock. And it's a list, and I'll show you some of this next week. But if we go back to this list, and I say, hey, I want you to go buy large cap growth companies, they're going to have a list of more than 8. They will have a list of 100 companies. And as soon as you put money in, they take that money and they spread it across those 100 companies almost immediately. Like, their job is to deploy that capital so it can start growing in those companies right away. That make sense? Okay. So we'll talk next week. In general, a mutual fund has a manager, and that manager is responsible for finding the best stocks in that genre or in that niche or in that asset class. Hey, look at big companies. Great, I'll try to find the best ones. There's also, we'll talk more about this next week, index funds that are literally, the word index just means list. So instead of hiring a manager to go try to find the best companies and actively find the best companies, you could just buy a list of companies, and a computer, as soon as you put money into it, passively puts it into those 500 companies. And so instead of a manager that you pay to go find good companies, you just go off a list, and a computer does it. You do have to pay the manager more money to do their job. The list is already out there and published on the internet, so you're now paying a computer to move the money around really fast. You still have to pay something, but you pay a lot less in fees. So that's an index fund that's passively managed, and index is just another word for list. Hey, make an index, make a list. It's a list of stocks or an actively managed. And I'll show you some examples next week of both. It's a really good question.